Today I will show you how to trade a day trading strategy on the 5 minute. We're gonna start on the higher time frame, make our way down to the 5 minute. I will show you how to find the right entry, where to put a stop, how to manage a trade, where to get in, where to get out, and everything else. So make sure to stick around until the end of the video to get the full strategy. So if we want to trade on the 5 minute time frame, we need to start our analysis on a higher time frame, and I really like the combination of 4 hour, 5 minute. On the 4 hour, we do our analysis, look for key levels, look for where are we in the bigger picture, and then we will make our way down. So on the higher time frame, we want to get a little bit of structure here. So we're starting with a naked chart. There's nothing else here. So what do we have? First, I always like to start the analysis by looking at where are the key swing points, where are major important support and resistance levels. And first of all, I mark the swing points here. You can see those really stand out. Those seem to be very obvious ones. Then I will just use horizontal line tools and connect those swing points and see, are those levels valid? Do they help us? And do they make sense? And you can see they mostly look okay. Just this one here in the center, it's not respected anymore. It was a very good resistance twice. Here on the left, it didn't seem to hold any value as well. And here the market didn't care at all, so we can safely ignore this one. And then we end up with 3 levels that we have. We have one right at the current price. You can see support here as well, and here the market bounced. We have one at the very low end, one at the very high end. And then we also have here a demand zone at the bottom that we need to know about. So this looks quite all right on the higher time frame. We don't need a lot more. What we also have to notice that we are in a downtrend. The market is in an overall range market, and in the range market you can see bullish and bearish waves are alternating, and you can see here we were in a bull market and now we are in a bear market. So that is the rest what we need to know from the higher time frame. So now we are starting with trading plan number 1. We're going to take what we have just seen from the higher time frame based on the trend structure, based on the level structure, come up with a trading plan, and then drop to the lower time frame to time our trade, place stops, targets, and also that's where we manage the trade. So on the 4 hour time frame, again, just a recap, we are in a downtrend. We want to participate in the downtrend, but we want to make sure that the market gets below the support level because it's a major support level it has held in the past. And also we want to make sure that the market is getting out of this consolidation. In a downtrend, you will often see the market goes up and down, back and forth. And if you want to trade a move to the downside, you want to make sure that those corrective waves are over and that the market is resuming into the initial trend direction. And we are essentially looking for something very similar to here. We could either trade only the breakout or a break and retest. So that is our plan. You can see the breakout occurred. The market is now trading below the support level, which is great. The close of this 4 hour candle is below the last close here that we have seen during the initial drop, which is good. It's a confirmation that the market is resuming into the trend direction. And now we want to capture this part here at the bottom. Now we drop to the 5 minute time frame, and on the 5 minute time frame we look for patterns and trend structures, because the patterns and the trend structure on the lower time frame help us to get into trades. And here we see a very interesting triangle. It's exactly what we want to see. You can see that the market had a very long, strong impulse wave to the downside. Then the triangle is the consolidation. And as I said, on the higher time frame, you will see that the market goes in those waves up and down, back and forth. And the same is true on the lower time frame. So we can really nicely time our trades using this wave rhythm. On the higher time frame, we saw that the market is resuming into the downside. We are clearing the correction phase here. And on the downside, we want to see exactly the same. Where you see that the market has moved to the downside. Here the market is moving up, and we want to see the market get out of this pattern now. So what we're going to do is create a trading plan. And first of all, you always want to make sure that you don't trade within those patterns. Trading within consolidation patterns is a very, very low probability trading plan because there's just so much noise in those patterns, and you can increase the odds significantly if you just wait a little bit to get out of those patterns. So this is what we see. You can see the market is clearing the lows. What does this mean? It means that the market is resuming here the trend structure of lower lows and lower highs. Within those triangles or within the consolidation, you will often see that the market is now making higher lows. This is not what you want to see when you're in a downtrend. But now you can see, since the market has cleared this low here, now the market is continuing to make lower lows. Now you can see a few candles afterwards, the market has cleared also the ultimate low of this impulsive wave. Some traders, if you are a little bit more aggressive, you may already get into the trade right here on the first breakout, first of all on the breakout of the pattern, but also the break of the last low. If you are a little bit more of a conservative trader and you want to wait all the way for the market to completely continue, make a lower low, that's totally fine as well. You will just have a little bit of a later entry. For stop loss placement, now we can really use our analysis on the lower and higher time frame very effectively. For stops, you definitely at least want to see that your stop loss is above the pattern here on the 5-minute time frame. That is already a good place to protect it. If you want to play it a little bit safer, you could place the stop loss also above this level, which comes from the 4-hour, from the higher time frame. It just gives you a little bit of extra confirmation. However, the trade-off is that your reward to risk ratio is going to be a little bit smaller because the stop loss is increased. When we zoom out, you can see, remember, this is the demand area that we identified on the 4-hour time frame. Demand and supply areas are very, very powerful. And if you find a very strong one, you want to make sure that your target is placed well above that, because there's a very high chance that the market will react to the level or to the zone. And sometimes the market is reacting to those zones if they are very strong, even before the market or the price gets there. And you can see we are right here, stop loss area somewhere around here, target somewhere around here. So you can see it's a very large reward to risk ratio. In this case, there's no need to have a small stop loss. So you could get a little bit of a wider stop loss, protect your target, protect your trade rather, and then you are not giving away too much of your reward to risk ratio. And you can see afterwards the market would have reached the low of the demand zone. There was a lot of back and forth. The market kept making lower highs and lower lows. But on a 5-minute, there can be more volatility depending on which pair you trade. This is the British pound US dollar, which is known to be a little bit more volatile. So be prepared for some more volatility. So it's not over yet, and we can create a trading plan number 2 and follow up based on what we have just seen. We zoom back out and go back to our higher time frame, back to the 4-hour, and you can see the market is now deep in the demand area. And I added the Bollinger Band. I added a Bollinger Band with a 2.5 standard deviation. And this is this purple line, what you see. It also comes from the higher time frame. So this is a daily time frame Bollinger Band. And you can see this is where the current Bollinger Band is right here. So what this means is that the market broke out of the Bollinger Band and then snapped back. So this is a Bollinger Band spike, Bollinger Band reversal, whatever you want to call that. And this is a very, very strong signal. It's even stronger when we look at the whole context. What have we seen? We have seen the market trading lower for a long time. So the downtrend has been going on for a long, long time. The longer a trend is going on, the higher the chances that it will reverse. You can also see it makes sense to see the market reverse here because we have a previous demand area. So a lot of things are coming together. And it would make sense now to look for a bullish opportunity, trade the market and trade the price back maybe into this level here that we identified earlier on in this video. So we go back to our lower time frame. We can stay on the 15-minute as well if that is what you want to trade. And what we have here is this is our level that we get from the higher time frame. And you can see it's a very, very nice resistance as well on the 15-minute. You can see we have multiple rejections here. We can also see very nicely that the market is giving us this wedge pattern. We have a triangle that is broken and being retested. The market is coming back into the resistance, which is a good sign. What we want to see for a trading plan is either a breakout or a break and retest. What we now see a little bit later is a very interesting added confluence, and the price after hitting the resistance here made a move lower, moved below this low, but immediately was rejected. So the market kept making higher lows, and as soon as the market attempted to break into a new lower low, the bulls came in and bought the price up, and in a very strong fashion. You can see this is a very, very strong bullish candle, something that we don't see often here. So this is already a good sign here that more bullishness is building up. A little bit later, the breakout occurs. And you can see shortly after the market is coming back. This is not a retest yet. This is something that many traders get wrong. This is not a retest yet. The market is in the process of retesting, but you want to make sure that you see momentum away from the level to confirm the retest. This is a very aggressive entry. Some traders trade those types of retests. You're going to have a very low win rate. Obviously, the trade-off is a high reward to risk ratio. In my experience, it pays off to have a little bit of a lower reward to risk ratio, but trade with a higher win rate. And you can see the next candle, a violent move higher, a super strong engulfing candle, engulfed this little candle here, but the range of the candle also completely engulfed the candle before that, which was already very large. So this is the perfect retest entry here that you see. For a target, we use a Fibonacci on the ABC pattern. We have the low of the move here, A. We have the high is the high here, point B. And the point C is perfectly the 50% Fibonacci, which coincides with this structure. And for Fibonacci targets, you can use the 138, 161, 200. Here's the big level from the 4 hour. And what you will often see is that traders scale out as the market hits 138, 161, 200. Another way of scaling into a trade rather than out of a trade is to wait for the market to break out of the 100. So if you get in on a Fibonacci, or if on a retest rather, on the first position, if you want to have a trading strategy to scale in, you could think about scaling in once the market breaks to 100. This is what you would see now, break and retest of the 100. So theoretically, if this is something that you're interested, this could have been a second entry. And the market cleared 138, it cleared 161, a little bit of a retracement is coming here. The market is moving lower. We could add the EMA 50 period to help us manage our trade. So what you would do in such a case is, by the way, here's the entry, the theoretical. You could add the 50, and then as the trend progresses, you would trail your stop loss along the 50 to help you lock in profits as the trade unfolds. You can see the market cleared to 200. The EMA keeps moving higher. Obviously is lagging behind the price, but that's the nature of the EMA. You can see the market is starting to round off as the price hit the big level from the 4-hour time frame. The EMA is coming closer to the price action, which is already a sign that the market is slowing down. And a few candles later, the market broke the EMA. So if you haven't been out fully by the time the market hit the higher time frame level, now you would have been clearly out here when the market broke the EMA, and potentially here was your trading stop. And you can see afterwards the market just continued sideways. So a very nice trading plan, top down, and we were able to trade it to the short side, back to the upside, and have a day trading approach.